In this video, I want to take a look at a ratio that's used heavily by investors, brokers and journalists alike, the price-earnings ratio. All I'm going to do in this basic introductory video is introduce why it's used, how it works, and also take a look at how to do some basic interpretation. In later videos, which I'd urge you to look at, we'll take a look at some of the weaknesses of the price-earnings ratio. It is by no means a perfect number, but it's quite a useful one in the right hands. So with no more ado, where do investors look to get returns from shares? And the answer is three sources. Share price growth is the first one, and that's really where PE ratios fit in. All right, that's where we'll be concentrating our efforts today, looking at potentially what sort of growth a company might be able to offer, and is that growth cheap or expensive? However, don't forget that as an investor, you may be looking at a company for other reasons. Dividend yields are an important part of the story too, and later on, not in this video, we'll take a look at dividend yields and ask the question, what sort of return do I get on the income side of owning a stock? Then there are perks, which I won't spend too much time on, the fact that sometimes you get discounts on products and so on if you're a shareholder. All right, but the PE ratio really is about focusing on potential future growth and asking one question, and that's this: is a stock cheap or expensive? Pretty fundamental question, and the PE ratio is one of the ways you can go about answering it. So with no more ado, what are the components of the price-earnings ratio? Well, the name sort of gives it away. The price-earnings ratio compares the latest share price. Now, that's something that you can look up. So the latest price per share is a key component of the price-earnings ratio. That will change. All right, share prices move hourly, daily, compared to earnings per share, and that gives you the PE. Now, earnings per share is quite an important component of a PE ratio, so let's just have a quick look at what EPS is first, and then we can go back to the formula, plug in a couple of numbers, and see how a PE ratio might work. Now, most of you will never have to do this in practice, but it's worth having an awareness as to where the numbers come from, because that helps with the understanding of the ratio. And earnings per share is basically taking a company's earnings or profits and dividing by the number of shares in issue. So essentially, it's what you get when you take a company's profits. All right, now profits, remember, are simply the difference between the revenue the company generates and all of its costs. That includes the operating costs, financing costs like interest, tax, and so on. So it's usually profits after tax divided by the number of shares that the company has in issue. Ordinary shares, usually, the voting shares. So, very quick example, if a company had made, let's say, £50 million of profit in 1 year, not bad going, and it's got 100 million shares in issue, then earnings per share, often expressed in pence, is just 50p. £0.50 or 50p. All right. So, very quick guide to earnings per share. More about it in future videos, but it's simply the profit for 1 year divided by the number of shares in issue. Now, were we to just flick back and put earnings per share in here, so there it goes, 50p. All right, and compare that to the latest share price for the company, which I'm going to assume is £2.50 or 250p. All right, nice to work in pence on the top and the bottom. Then the PE multiple comes out at 5 or 5 times. All right, it is a multiple, so it's right to talk about 5 times or a multiple of 5. Now, what does that actually tell you? By itself, not much. Okay, the basic interpretation is this: if you're prepared basically to buy the share for £2.50, that's the current share price, excuse my slightly squiggly writing there, all right, that implies at current earnings of 50p per share, there were nothing to change, earnings not to move, you'd be prepared to wait 5 years just to get your money back, just to get your £2.50 back, okay? Well, that might sound all right. You might say, well, I would wait 5 years, but if you think about it, the PE ratio could be much higher than 5, right? If the share price is much higher than £2.50, but earnings per share is still 50p, the PE multiple could easily rise to 10 times, for argument's sake. All right, if the share price doubled, PE multiple would be 10 times. There's no reason why, in theory, the PE ratio couldn't be 50 times. And we've even seen instances where PE ratios hit 100 plus, okay, around the time of the dot-com boom, for example. So what's that saying? Is that saying that people are prepared to wait 10 or 50 or 100 years just to get their money back, let alone make any, at current rates of earnings? No. It must be saying that higher PE ratios tend to imply high future earnings growth potential. People are expecting the company's earnings down the bottom here to sharply rise, and they're prepared to pay for that now. Right? That's the key. All right? So what we're saying with PE ratios is they are a function of the share price, that's set by the market, by people buying and selling shares, and 1 year's earnings per share figure. All right? Typically, the last 12 months is often used. That's called a historic PE. But some people would say, well, I'm not looking backwards when I buy shares, I'm looking forwards. So sometimes that's a forecast of the next 12 months earnings figure. Now, how do I know if a PE ratio is high or low? We need to compare it to something. So if a company, for example, has a PE multiple of 10, take the middle one, what would I do there? Well, perhaps I could compare it to other companies in the sector. Perhaps I could compare it to the FTSE 100. So if the FTSE 100 had a PE multiple of, say, 13, 14, 10 would be relatively, and that's what it's all about with PE multiples, relatively cheap. Okay? If, on the other hand, the FTSE 100 companies all traded on PE multiples of just 5, all right, then you'd say that 10 suddenly looks like quite a lot to pay for 1 year's earnings per share. All right? But there is a degree of subjectivity and judgment here. So let's sum that up. Basic interpretation, a high PE relative to other stocks, relative to the wider market, suggests the company has decent growth prospects. A very high PE, very decent growth prospects. Or, don't forget this is a market view. Who sets the share price? Investors trading the share, buyers and sellers. So it could suggest, hence the or, that actually a company's share is too expensive. This is the thing, interpretation is the key. All right? And that's where a bit of judgment's required. Maybe the high PE ratio is justified, or maybe the market's got a little bit ahead of itself, investors have got a little bit excited, marked the share up relative to 1 year's earnings, and there's trouble ahead. Okay, the share price relative to earnings is too high, the PE is not justified. Equally, usually textbooks would say a low PE suggests a share has low growth prospects, or if you're a bargain hunter, maybe the market's got it slightly wrong. All right, maybe the share is cheap. But you always have to look at the reason why a company has a high or a low PE ratio. It's not something you can just take at face value and say that's definitely cheap, that's definitely expensive. It requires judgment. Okay. Now, just looking around the market to finish off, January 2014, what are we seeing? Where are the higher PEs? Where are the lower PEs? All right. Well, at the moment, higher PE, higher growth expected doesn't necessarily mean the shares are overpriced, but higher PE ratios, technology, electronics, and healthcare. Those are sectors expected to deliver growth, and if they do, shareholders can do quite nicely. Small caps tend to have higher PEs than large caps. People expect more from small caps, all right? And that can be perfectly justified in the right circumstances. On the right-hand side, lower PE ratios, utilities, mining, and tobacco stocks. Why? These are companies that, for various reasons, have limited growth potential. Perhaps they've saturated their natural growth markets. Perhaps they're regulated, all right? So they tend to attract lower PEs. Bigger stocks, as a rule of thumb, tend to have lower PEs than smaller stocks. But does that mean, ooh, you don't want those? All right, no growth prospects, why would I want to buy those? No. All right, worth bearing in mind that some of those sectors can be the ones that offer those juicy dividend yields that I talked about, the other side of owning shares. So there we have it. In summary, the PE ratio, widely quoted, heavily used, can be a useful guide to whether a stock's cheap or expensive, but a fair amount of caution is required when it comes to interpreting PE ratios. Remember, Mr. Market, as I call him, is normally right, but sometimes gets it wrong.